This video, we're going to break down exactly what ULTY has been doing in the market and my total return for ULTY. I have about 1,500 shares invested in ULTY. As we can check on our Robinhood, cost average is just under $6 per share, 1,500 shares. Total share price return is down 14% or about $1,300. And that is what a lot of people are going to be scared of, because we take a look at the share price year to date, it's down 43%. And a lot of people actually bought into this ETF around June, July. So they have a cost average of about $6 or even higher. And the share price decline is about $1 since that time. I'm going to share with you the total return, including the distributions. Now, keep in mind, I am not reinvesting the distributions automatically. Every now and then, I may buy some additional shares, but I am doing that on my own. So when I see nice dips, I am buying more shares in order to lower my cost average, because I don't want to reinvest into this ETF when we're at market highs, such as $6.40. I wouldn't want to buy shares at that price point. But if we see market declines, if we see ULTY dropping below $5 per share, I may add some more to the portfolio. Now let's briefly go over what ULTY is, what the strategy is, and if it may be a good fit for your portfolio. So ULTY is one of the most talked about YieldMax ETFs on the market, and it's the Ultra Option Income Strategy ETF. Now it's going to be an actively managed ETF. It seeks to generate weekly income. Remember, they changed from monthly to weekly payouts back in March, and that has soared the popularity of ULTY because people love weekly income. It's just a lot better when you're getting payouts more frequently. But in this ETF, you're going to have a portfolio of covered call strategies, each on a US listed security. And I've mentioned this time and time again, investing in ULTY is of course very risky. Because of ULTY's investment strategy, it's going to give you indirect exposure to gains, if any, of the share price returns of the underlying securities, which is going to be capped, because covered calls are going to cap your upside in order to generate weekly income. And of course, here is where the risk comes into play. It's subject to all potential losses if the shares in its portfolio decrease in value. Now, because you are getting weekly income, it would not drop as much as just buying the underlyings directly. So why would you choose this fund? The main reason is going to be the weekly income. It's been paying out pretty consistently, and we will go over in the distributions in this video later. But for now, the fund is going to provide the potential for regular weekly income through covered calls, and it's going to be a quote-unquote diversified portfolio. I'm not a huge fan of single stock ticker ETFs, such as TSLY, which is based off of Tesla itself, because I think there is too much risk involved with a single stock ETF such as that, because you're relying solely on that underlying, which in that example would be Tesla. So if Tesla takes a nosedive from bad earnings or whatever, then you are going to lose a ton of value on that ETF. So in this ETF, it's going to invest across 15 to 30 underlying securities selected primarily based on implied volatility levels. And this is why I say this is a risky ETF. Even though it is diversified across 15 to 30 stocks, it is going to choose those stocks based on high implied volatility and how speculative they are, because you're going to be collecting a lot more option premium from those covered call strategies, which in return, you're going to have a much higher distribution rate. Now, the third point a lot of people can disregard, it states it's going to have upside participation, but we've seen the share price, it doesn't have too much in terms of share price appreciation. Now, it may have a little bit of an increase, but you're not going to rally with the entire market if the entire market has a huge bull increase. Now, if we take a look at the dividend history for ULTY, here is why I love this ETF. We can see it's been paying out very consistently between 9 and 10 cents, sometimes 11 cents per share, as low as 8 cents per share. So it's been paying out very consistently week over week since March, which is very good to see for people who are investing in an income fund like ULTY. And there's a lot of different weekly paying ETFs out there. There's actually more than 130 weekly payers, which is absolutely crazy in my opinion. But a lot of them are kind of risky. They're single stock ETFs. And I think that ULTY has been very consistent with its payouts, even though the NAV has decreased, which is a big concern for a lot of ULTY holders. And if we take a look at the current holdings, we can see it has some very speculative, very volatile companies, and you have to be bullish on their underlyings. If you are bearish on most of the holdings, do not invest in this ETF because you want these underlyings to perform well, and that is when the ETF itself will perform well as well. So we have Rocket Lab Corporation, we have Palantir, Robinhood Markets, Coinbase, Rocket Companies, Hims and Hers Health, MicroStrategy, Upstart. So a lot of companies that have high implied volatility. And keep in mind, they're always swapping in and out their holdings, so it is actively managed. You are going to be paying a higher than normal expense ratio, which is going to be 1.30%. Now, this expense ratio is actually going to be a lot higher starting in February of 2026 to 1.40%, which is absolutely insane in my opinion. But for now, 1.30% is quite high as well. And if the total returns don't justify this expense ratio, you may want to find another ETF better suited for your own personal strategy, whether it be something that's a little bit cheaper in terms of expense ratio or something a little bit more stable in terms of the NAV, which there are many options for. So let's go into my total return in an investment. I have 1,500 shares of $5.96 cost average, and I am down in the share price 14%, or about $1,300. So on paper, this does not look great, obviously, but we're going to be scrolling down. We're going to go to the history of all the distributions that we've made, and if we refine the results, we will get our whole dividend history. So we can see we've received payments all the way up from May all the way until October, which is now. And we can see the payouts have been pretty consistent and have in some cases increasing as I've occasionally added more and more shares over time. Now it might be a little bit hard to read from here, so I've plugged it into a spreadsheet, all the distributions from ULTY from October 24 all the way until May 30, where we received our first distribution. And distributions have been growing because I have added especially a lot more during this August timeframe, where I invested a lot more money into ULTY to increase the weekly distributions. And adding all these up, we get a total distribution amount of $2,074.40, which is amazing, considering that it outweighs our share price loss from ULTY, which was $1,300, as we can see right here, which means our total return was actually a gain of about $700, and our total investment was about $9,000. So if we plug this into a percentage calculator, $700 of $9,000 investment is about a 7% gain, almost 8%, which is absolutely amazing in just a few months since May-June timeframe. Now, the biggest misconception that I've seen with ULTY is looking at the distribution rate alone. It says 90%. Realistically, you're looking at 70 to 80%, but right now it's at a high point, 90%. You're not going to be making 90% annually. That would be absolutely insane because we are going to have some NAV decay that you have to factor in, but over time, the distributions should outweigh the NAV drop. And of course, if it doesn't, definitely choose some other ETFs in those cases. But looking at these distribution rates alone and choosing the ETF based on that is not a very good idea. Now, if you take a look at the total return year to date, you can actually see it's up 13.65%. And this is considering you have a dividends reinvested. Now, if I had reinvested all my distributions back into ULTY, I would be up a lot more. But right now, I'm just keeping them as cash payments and just occasionally adding more shares as time goes on. But if you are reinvesting your distributions, you would be up almost 14% year to date. And if we take a look at the total return since inception, you're actually up 14%, which is kind of crazy because if you look at the all-time for ULTY, you are down 75% since this ETF came out at $20 per share in February of 2024. So looking at the share price alone is not going to play into the whole picture of your total return. It can be a little bit hard to track your total return. A lot of brokerages do not do that. I use Robinhood, which I have to manually calculate my total return. But what I do is I just go to the distributions, I copy it, I paste it into ChatGPT, and it gives me a nice formatted picture of my whole total return. And I just plugged it in to the spreadsheet right here, which is very easy to read and lets me see how the ETF is actually performing. So let me know down below in the comments, are you still holding ULTY? What is your plan with this? And if you are not, what other options are you investing in? WPay has been one of the most popular ETFs as a weekly payer because it is a fund of funds of all the Roundhill weekly pay ETFs. It's been performing quite well and it does have that share price appreciation, but it is risky because that one has leverage. Overall, 1,500 shares. I may add some more if the share price of ULTY drops more, but I've been pretty happy with the consistent payouts. As I mentioned earlier, it's been paying out about 9 cents per share, which we can see it's been doing that quite reliably. And in my opinion, that is a very good thing. So let me know down below. Thanks for watching.